Welcome to Your Wealth by Design, a low-stress, systematic approach to investing. This is my attempt to build that system. Content is for entertainment and informational purposes only. This works for me, may not be appropriate for you. I'm not a financial advisor. This is not financial advice, so please do not research for making decisions with your own money. Let's jump into the portfolio. So you can notice a striking contrast. There are some things missing. On Thursday's video, we removed all of our negative trends. We focused our approach to only trend following and not mean reversion. And surprise, surprise, look at that. If you only hold what's winning, your portfolio goes up. Yeah, shocking, I know. Let's quickly run through our performance versus the indices. On the day, we are up 3.45%. This was for Friday, by the way, versus 2.16 for the world index, that's a beat, 1.95 for the S&P, that's a beat, and 2.11 for the QQQ, that is a beat. If we look at year to date, we are on our way back up, down 1.8% versus the world index, up 3%, the S&P up 1.1, and the QQQ down 0.57. The world index is the one to beat. Looking at our top performers, it's going to be Japan and industrials. Everything else is more or less in line, with utility lagging a little bit. But this is old news because I spent all day Friday putting in a lot of work. Before I go through the changes, let's go ahead and take a look at the state of the market. S&P has recovered. We are back above the 50-day moving average. Volatility is dropping and decelerating considerably. Our DCA has gone from roughly $130 a day to $170. So confidence is restoring in the markets. QQQ is the only one that's still in negative trend. The world index is recovering extremely fast and robustly with it's a low score, but considering where it was, it recovered very quickly. And you'll notice that there are a few more holdings than the 24 previously. So a lot went into this, and I won't have time to explain everything today, but over the coming days, we'll go over more. So on Thursday, this is what the model looked like. Took a screenshot because I wouldn't be able to have it available today. But just to recap our discussions from Thursday, we were holding everything always, even when things were in a negative trend. And I would try to reduce the position size to as small as possible, which M1 is 1%. But even then, you know, if something's moved down 30%, even if it's a 1% holding, that still has they add up quickly. All these negative trends were adding up and weighing down my portfolio. So even when I removed them and just focused on the positive trends, you still have a similar problem. And it's very clear when you're looking at the results of Thursday. I'm holding two broken trends. The whole point of a broken trend is it's over. You know, it might have some lingering performance, but I need to get out of it. A broken trend, even with some positive performance, is still a negative draw on the portfolio. I have to get rid of it. Also, I don't necessarily want to hold every positive trend. I want to hold the best positive trend. So I had to come up with a system to do that, because as you can see, gold here is still a positive trend, but the trend just broke. Hasn't proven anything yet. So why would I continue to hold it? Also needed to be addressed. And additionally, I needed to come up with a way where whatever this borderline is not going to have, on a daily basis, tickers entering and exiting the portfolio. If it's in the portfolio, it needs to have a chance to ride the trend. With all that said, you notice that we've gone from 24 tickers to 600 tickers. By not requiring myself to hold every asset always, that allows me to basically pseudo hold everything, which really just means track. There's no reason to hold on to negative trends waiting for mean reversion when my model correctly identifies them as negative, and when it correctly identifies them as going from negative to positive, and then again when a trend is established, it'll score it accordingly. I have far more granularity available to myself. In the original 24 tickers, I had the Fidelity sector index funds. I did that because I originally wanted more control over the S&P. At the S&P, you're forced to buy everything, and it's just static. If it's down, you're down. It's up, you're up. You have no control over what you're investing in or whether or not you're holding those winners and losers, which is why I created the model. It was based on the theory that, like, what if you could own the S&P, but only hold the winners, what's winning, and not hold the losers, which I think is ironic because I would then go on to create a portfolio where I did exactly that. I held the losers. It makes no sense, so we're fixing it now. So with that said, Invesco and Global X. With those two combined, I was able to create country-specific ETFs. And because I'm not forced to hold them indefinitely, the expense ratio no longer matters. I originally avoided these ETFs with this level of granularity because they're more expensive, but I only hold them when the trend is superior. I don't care about, a 0.6% expense ratio if it's returning me 30% a year. But if I was forced to buy and hold it for 5-10 years through the ups and downs, yes, 0.6% expense ratio would be absurd. I don't need to hold every single international company. Everything comes at a trade-off, and for now this is the best I can do. As the model proves itself out, more granularity becomes an option. In addition to country-specific ETFs, I now have the option to participate in commodities. Paper contracts, they're options, so they're not investments. So now that I'm not forced to continuously hold them, I can use them for what they actually are. If a trend emerges in commodities, I can be a part of that trend. And when it's no longer a trend, I can exit the position, which is fantastic. In place of the sector ETFs, I have roughly the top 500 or so of the US companies. I just have all of them, not the ones specific to the S&P 500 because that relies on a committee and inclusion, but just by market cap, the top 500 or so US companies. I have them all. So what that means is that if at any given moment, somebody somewhere is probably seeing some outperformance and I can be a part of it. So instead of on days like Wednesday or Thursday, whenever it was, whenever the market crashed and it seemed like everything was red, that's usually not the case. It seemed like there was no safe place to hide, but now I should be able to find those places that are safe to hide. All sectors are represented to varying degrees. So if any specific industry or sector are trending, I can be a part of it. So it still accomplishes everything that the sector ETFs were accomplishing, but I can actually specifically just hold the winners and not the losers as well. I still hold my gold and silver, and I still hold crypto. And because I'm holding the top 500 largest companies, I still need a size factor tilt. So I am still holding small and mid-cap domestic and international ETFs. If those funds happen to be outperforming individual stocks, I still have access to them. I finally have a reason to hold debt. Usually insurance comes at a price. Most of this debt is insurance. If the market crashes, then you hold these so that they will move in opposite to equities. They're negatively correlated. But as you can imagine, that negative correlation cuts both ways. If equities are on a tear, a certain percentage of your portfolio is just a constant drag. Just in case the market turns one day and then suddenly you have something green in your portfolio. I don't have to hold these. I can track them. And if they start outperforming equities at any given time, then I will identify that and I will hold these. Okay, so that's the rundown. This took a long time. Reasoning through all these things, setting it up logistically, determining how to score these things was quite challenging. I've replaced the relative performance to just the average. It just displays what the average performance is across everything that is listed, which is like the world investable assets. The average performance is about 1.23%. So that gives you a sense of, are the ETFs performing in line with average, below, or above? With all that said, these are the new holdings that I'm going to invest in on Monday. So a few concerns that I'm going to watch for. One, if every day these holdings are changing, then it's too sensitive. It's not giving me enough time to build into a trend. And if that's the case, then I will need to slow this model down so that I can have time to identify trends and build up positions in them. Another thing to consider is I want to make sure Hershey gets out of the portfolio. If it just slowly trickles down and I bleed out all the gains until it's out of the portfolio, that's bad. So I look forward to observing this over the coming week, and we'll make intelligent changes according to its actual performance in the market. The experiment continues. I appreciate y'all stopping by, and I will see y'all on Monday.